Welcome to the debate. Imagine standing in front of a billion-dollar glass and steel skyscraper.
Okay, I'm picturing it.
You walk into the lobby, and everything is just flawless. Polished marble floors, automated climate control, state-of-the-art security.
Processing thousands of people a minute, right?
Exactly, with absolute precision. But then you take the service elevator down to the basement. You step out, expecting to see a high-tech control room, and instead, you find that the entire foundation of this magnificent building is held together by duct tape, baling wire, and a crew of exhausted engineers manually bracing the support beams so the whole thing doesn't just, collapse.
It's a great analogy because, believe it or not, that is exactly how modern global enterprise finance works right now.
Right? It really is.
I'm ERP systems to manage millions of transactions at the individual entity level, so that's your polished lobby. But at the group consolidation level, where the ultimate financial reality of the entire global enterprise is supposedly assembled, the process is, it's structurally primitive.
Completely primitive. I mean, it's heavily reliant on manual data extraction, fragile spreadsheets, and late-night human intervention.
Yeah, the classic midnight accounting scramble.
Exactly. We call this the consolidation paradox, and the central question we're exploring today, which is drawn directly from recent extensive analyses on the unified ledger imperative and group P&L architecture, is this. Is this multi-entity consolidation problem fundamentally an architectural failure that technology can resolve via a unified group ledger, or
is it fundamentally a governance and accounting complexity problem that a new architecture merely helps manage, but cannot actually eradicate?
spot on? And how we answer that question dictates where a CFO invests millions of dollars and, frankly, thousands of hours of their finance team's capacity. So I will state my position clearly up front. I argue that the multi-entity close is fundamentally an architectural problem solvable only by deploying a unified group ledger with source-agnostic, real-time drill-through capabilities.
And I argue that while architecture provides better control, the core hurdles of consolidation like multi-gap adjustments and intercompany eliminations are substantive accounting judgments that inherently keep the group P&L a carefully managed reality rather than a purely automated truth.
All right, so to really set the stage for this, we have to acknowledge a somewhat uncomfortable truth. If you're listening to this and you've ever worked in corporate finance, you are probably nodding your head right now.
Oh, they definitely are.
The current state of the consolidated group P&L is essentially an elaborately constructed fiction. Or, if we want to be polite, a controlled estimate.
I think most controllers would defensively prefer controlled estimate, but go on.
Right, well, the structural failure stems directly from disparate ERPs. Think about it. You have SAP running in your European division, Oracle in North America, and maybe, 3 different legacy mid-market systems lingering from past acquisitions in Asia.
The classic Frankenstein system.
Exactly, and they all speak completely different languages. Because the architecture is fundamentally broken at the group level, finance teams are forced to bridge this gap manually.
With spreadsheets.
With massive spreadsheets. They export raw data and manage incredible complexity through manual VLOOKUPs, pivot tables, and these huge static files. The only genuine permanent solution is an entirely new architecture. We need a source-agnostic platform that sits above all these disparate systems and establishes a single unified group ledger.
Okay, but
by providing full drill-through visibility from the top-line consolidated P&L directly down to the source transaction at the entity level, we transform that controlled estimate into verifiable absolute truth.
Look, I certainly acknowledge the profound pain of spreadsheet-based consolidation. No one is defending the status quo here.
Good, because it's indefensible.
Fair enough. There is universal trauma in finding a href error at 2 o'clock in the morning on a Friday because a subsidiary in Germany decided to add a new row to their trial balance.
Exactly.
But the vision you're painting, this idea of automated, verifiable, absolute perfection, drastically overstates what software can actually do. The source material we are looking at explicitly names the causes of consolidation failure. We're talking about multi-GAAP reporting, where local accounting rules clash with international standards. We're talking about varying fiscal year ends and highly complex currency translation differences.
But I mean, those are data management issues at their core.
I come at it from a different way. They aren't just data extraction problems or simple mapping issues. They are substantive, highly nuanced accounting decisions. A unified ledger doesn't eliminate these inherent complexities. It simply provides a structured library for human accountants to continue making complex, subjective judgments.
A structured library is a massive upgrade, though.
It is, but the software doesn't magically decide if a highly specific operating lease should be capitalized under local rules versus international rules, you know? A human being does. Therefore, no matter how good the tech is, the consolidated number remains a governed estimate.
Well, let's break that down, starting with what you called simple mapping issues, which is actually the first major hurdle, the data heterogeneity problem.
Sure.
Organizations grow organically, right? They acquire competitors, expand into new regions, and they just inherit this chaotic mixed landscape of systems. Let me offer a way to visualize this. Relying on manual spreadsheets to consolidate data from SAP, Oracle, and those legacy systems is like trying to translate a dozen different dialects into a single, legally binding contract using only a pocket dictionary and a stack of sticky notes.
That sounds like a legal nightmare.
It is fraught with risk. The entity in the US categorizes revenue completely differently than the entity in Japan. A properly architected unified ledger introduces a standardized group chart of accounts. It acts as a universal semantic foundation. You map the local accounts to the group standard once within the platform, and you permanently solve the translation issue. The data finally speaks one language.
Let me stop you right there. The idea that you just, quote, map the accounts once and the translation issue is permanently solved completely ignores the dynamic, living reality of enterprise business.
How so?
Well, the source text itself contains a vital caveat here. This semantic mapping is explicitly not a one-time exercise. Corporate structures are living organisms. Entity account structures constantly evolve.
Sure, businesses change, but the architecture handles the standardization.
But the human effort doesn't disappear. Let's say a subsidiary acquires a smaller company, or a new regulatory requirement in Brazil forces a change in how specific tax cost centers are tracked.
Right.
Or the business launches a new digital service line requiring entirely new revenue classifications that just didn't exist when you set up your perfect unified ledger. The platform does not solve the heterogeneity. It merely moves the manual effort from an end-of-month spreadsheet scramble to an ongoing, permanent data governance burden. You still need an army of finance professionals maintaining, debating, and updating those mappings every single month.
I see why you think that, but let me give you a different perspective. Moving from an undocumented, fragile spreadsheet managed by one stressed analyst at midnight to an explicit, version-controlled, auditable data governance workflow is not just moving the effort. It is a fundamental transformation of control.
I'm not denying it's better control.
Think about the mechanics, though. In a spreadsheet, a broken link quietly corrupts the data. In a unified ledger, the mapping is a first-class object in the architecture. It alerts you if a new local account is unmapped. It prevents the data from flowing until the rule is defined. You remove the catastrophic risk of a hidden formula error, wiping out millions of dollars in reported revenue.
I agree the control environment is vastly superior, but we have to be honest with the listeners about what the technology is actually doing. It is enforcing rules created by humans. It is not generating truth on its own.
Fair enough, but let's follow the data upward. Let's say I grant you that the mapping requires ongoing human governance. Once we have that semantic foundation, once we've built the perfect universal translator for the data, we still have to apply the accounting rules, which brings us to the multi-GAAP problem you mentioned earlier.
Right, because the data speaking the same language doesn't help if the underlying laws of physics, the accounting rules themselves, are completely different depending on what country you are standing in. And this is where the limitations of automation become glaringly apparent.
They're hurdles, not walls.
The multi-GAAP problem is immense. You have entities reporting locally under US GAAP, Brazilian GAAP, Japanese GAAP, but the parent company needs to consolidate everything under IFRS for the global investors. And for those of our listeners who might not deal with international accounting daily, we aren't just talking about using different names for the same things.
No, the measurement principles themselves are different. Exactly. The text points out that these standards require fundamentally different recognition and measurement treatments for the exact same underlying economic events. Let's take a specific, relatable example. Let's say you have a 5-year lease on a warehouse.
Okay.
Under one set of local accounting rules, that lease might be treated purely as an operating expense. You just record the rent payment every month on the income statement. Simple. But under IFRS 16, at the group level, you might be required to capitalize that lease. You have to recognize a right-of-use asset and a corresponding liability on the balance sheet, and then you record depreciation and interest expense instead of just rent.
Which drastically changes your EBITDA and your debt ratios.
Exactly. The economic reality, renting a warehouse, is identical, but the financial representation is completely transformed. And then you layer on currency translations, which is its own nightmare. Oh, absolutely.
When consolidating, you have to use closing rates for the balance sheet, meaning the exchange rate on the exact last day of the month. But you use average rates for the income statement. And for equity, you use historical rates, the exchange rate on the day that specific stock was issued, which was maybe 10 years ago. If you try to build that in a spreadsheet, the math literally doesn't balance.
No, it breaks constantly.
It forces accountants to create plugs, foreign exchange translation adjustments. The text is very clear here. These are substantive accounting decisions. Software cannot interpret the economic substance of a complex lease agreement, and a simple formula cannot tell you if an FX adjustment belongs in the P&L or buried in equity.
I'm not convinced by that line of reasoning because you are missing the profound architectural shift in how these adjustments are handled in a modern system. Yes, human expertise is required to initially understand the difference between local GAAP and IFRS on that warehouse lease. Nobody is debating that.
Okay, so you concede the human element.
Initially, yes. But the text explicitly contrasts managing these adjustments as a periodic crisis under intense time pressure versus maintaining them as a versioned, auditable body of accounting work.
What does that actually mean in practice, though?
It means that in the manual world, a complex GAAP adjustment for that warehouse lease is a standalone spreadsheet. It was probably built by someone 3 years ago who has since left the company, right? And the current staff just copy-paste the values forward every month, hoping the underlying formulas didn't break.
Sadly accurate.
Under a unified ledger architecture, that adjustment becomes a managed library of templates. The system natively understands the difference between a closing rate, an average rate, and a historical rate. The accountant defines the rule once, treat this warehouse under IFRS 16, and the architecture automatically calculates the depreciation, applies the correct historical exchange rate to the equity portion, and balances the entry. It upgrades these human judgments into first-class data objects. It fundamentally changes their reliability from a chaotic guess to a reproducible, structurally sound accounting outcome.
That's a compelling argument, but have you considered what happens when the underlying realities simply don't match up? Let's move away from leases and look at the absolute black hole of group finance. Intercompany eliminations.
Oh boy.
This is where even the best architecture hits a wall of human reality.
The intercompany mismatch is definitely the biggest pain point for any global controller.
For sure. And for those who haven't had the pleasure of dealing with this, the theory, as the text notes, is perfectly clean. Entity A sells widgets to Entity B within the same corporate group. It's the same company moving money from the left pocket to the right pocket.
Exactly.
When you consolidate the group financials for external investors, those transactions should cancel each other out to exactly zero. You can't report revenue from selling to yourself. It should be invisible. But in practice, they never quite clear. And this isn't just about applying a version-controlled template. It's about fundamental mismatches in reality.
And that is exactly where the strategic value of the architecture becomes undeniable. Walk me through what happens right now in a manual process when they don't clear.
And days emailing and calling each other across time zones, trying to figure out why Entity A in London shows $1 million receivable, but Entity B in New York only shows an $800,000 payable.
Right. Where's the missing $200,000? Eventually, under a looming reporting deadline, they just force a pragmatic correcting entry to balance it out, which is, as you said earlier, the definition of a controlled estimate.
Exactly. And a unified ledger introduces the ultimate standard to solve this: full drill-through visibility. Think about the mechanics of this, because the platform sits above all the disparate ERPs and connects directly to the granular source data. The CFO or the auditor doesn't just see a top-level imbalance.
Okay, they can click on the consolidated intercompany line, drill straight through the adjustment layers, and look at the native source transactions from both London and New York in seconds. It replaces the forced estimate with absolute verifiable certainty. It fundamentally changes the CFO's relationship to the accounts. You don't have to route questions through a chain of manual investigation. The truth is instantly visible on the screen.
I'm sorry, but I just don't buy that.
Really? Why not?
Let me tell you why. Drill-through visibility is incredible for forensics, absolutely, but it does not resolve the mismatch. It only shows you why there is a mismatch. Let's look at the actual mechanism of why these balances fail to clear. Let's say entity A ships the widgets from London on March 31st and records the sale in British pounds. Entity B in New York receives the goods on April 2nd and records the payable in US dollars.
So you have a timing difference and a currency difference.
Exactly. And the exchange rate changed between March 31st and April 2nd. The drill-through you love so much will perfectly illuminate that entity A booked it in March and entity B booked it in April. But the software cannot magically reconcile a physical reality of trucks crossing oceans.
Well,
It cannot automatically negotiate the correct transfer pricing adjustment when the two entity controllers disagree on who bears the foreign exchange loss. Human investigation, discussion, and negotiation between those controllers is still entirely required to resolve the discrepancy. The unified ledger gives you a much better flashlight, absolutely. You find the problem faster. But you are still navigating a fundamentally human workflow to fix it. The reality of the mismatch remains a governance problem, not just an architectural one.
That's an interesting point, though I would frame it differently. By giving the controllers that better flashlight, you completely change the nature of their work. Ask any accountant. They are currently spending 90% of their time just trying to find the missing data in a haystack of spreadsheets.
That's fair.
The architecture finds it instantly. So now they spend 10% of their time reviewing the precisely identified discrepancy. It's a timing difference from April 2nd, and they use their expert judgment to resolve it. That is a massive paradigm shift in productivity and accuracy. And it leads us directly to the final, crucial piece of this puzzle, the multi-output imperative. Because finding the truth internally is only half the battle.
Right. How we actually present this reality to the outside world, the final deliverables.
Yes. The group consolidation process doesn't just produce one report. It has to serve multiple masters. You need management reports for the board, statutory financial statements for local governments, data feeds for external platforms, and increasingly, mandatory IXBRL tags for digital regulatory filing.
Let's unpack IXBRL for a second, because that's a huge driver of this architectural shift.
It is. We are moving into an era where regulators require IXBRL tags. These are essentially digital barcodes attached to every single financial number, so algorithms and regulatory computers can automatically read the reports. It's not just saving a document as a PDF.
Right, it's machine readable.
If your data is stitched together with VLOOKUPs, applying those digital barcodes accurately across multiple outputs is practically impossible.
And the risk of a tag slipping to the wrong row in a spreadsheet is terrifying.
It's game over for your audit. In the primitive state, different teams are manually re-preparing the data for each of these outputs, multiplying the risk of error every single time. A unified ledger architecture produces a single, validated dataset from which all outputs are generated. And crucially, it redefines the role of Excel.
Excel.
We all know finance professionals will never give up Excel, and honestly, they shouldn't have to. The architecture preserves Excel strictly as a presentation layer for the board, while completely eliminating the data management risk. The numbers flow directly from the validated unified ledger into the Excel template via a direct connection. No more broken formulas, no more hard-coded manual adjustments right before a board meeting. The architecture guarantees the integrity of the data from the ledger to the final presentation.
I completely agree that separating data management from the presentation layer is a wise and necessary evolution. Excel is a terrible database, but a wonderful canvas. But I think this final point actually proves my overarching thesis. At the end of the day, after all the automated mappings, after all the templated multi-gap adjustments and all the instant drill-through investigations, the finance team still has to export this into an environment where human curation, presentation conventions, and executive judgment take over.
But they are working with validated data.
Yes, but the presentation of that data is subjective. The CFO decides how financial performance is most clearly presented to the board. They decide which adjustments to highlight and which variances require narrative explanation. The architecture serves the financial professionals. It does not replace the fundamental nature of their work. The final numbers presented to the board and the public markets are still the product of expert human estimation, negotiation, and presentation. Technology is the vessel, but human accounting judgment is the cargo.
As we begin to wrap up our discussion, I look at the multi-entity close not just as a larger version of a single entity close, but as a categorically different problem that demands a different structural response. You simply cannot manage this level of complexity by just hiring more accountants to build bigger spreadsheets.
We definitely agree on that.
The consolidation paradox is only cured by deploying a unified ledger architecture that addresses data heterogeneity at its root, upgrades complex gap adjustments from periodic crises to managed libraries, and most importantly, provides real-time drill-through from the consolidated group figures straight down to the source transactions. It moves the finance function out of the exhausting business of managing manual complexity and into the strategic business of achieving verifiable, absolute control.
And while I absolutely agree that a better architectural foundation is necessary, because as we've discussed, the current spreadsheet-heavy status quo is unsustainable, highly prone to errors, and frankly, a massive waste of top-tier accounting talent, I maintain that true group financial intelligence will always remain a carefully governed human process.
Because of the ambiguity.
Right. The inescapable realities of global enterprise finance cannot be coded out of existence. We are always going to have competing international accounting standards. We are always going to have constantly shifting corporate structures and acquisitions. We are always going to have complex intercompany business dynamics where shipments cross oceans and exchange rates fluctuate. A unified ledger builds a much more robust, transparent framework, but it is ultimately just a framework for managing the unavoidable ambiguity of enterprise accounting. The consolidated P&L will always be a reflection of expert human judgment.
We certainly agree that the days of managing multi-billion-dollar global enterprises on static spreadsheets need to end immediately. Where we continue to diverge is on the ultimate ceiling of what this new technology represents. Does a unified ledger entirely cure the consolidation paradox by delivering unassailable architectural truth? Or does it simply build a safer, more transparent arena for managing inescapable accounting ambiguity? It is a fascinating tension.
It really is. And for our listeners looking to dive deeper into how these two perspectives play out in the real world, the source material offers incredible technical detail. We barely scratched the surface today. I'd highly recommend looking into the specific mechanics of IXBRL digital integration we touched on and the deep complexities of automated exchange rate methodologies. Understanding exactly how closing rates versus historical rates impact equity translation really highlights the fascinating intersection of system architecture and accounting judgment that we've been debating today.
Viewing enterprise finance through both a technological lens and an accounting governance lens is absolutely essential for any modern financial leader. It brings us right back to that skyscraper we started with. Whether you believe a unified ledger actually replaces the duct tape foundation with solid steel, or whether you think it merely provides those exhausted engineers in the basement with much better tools to hold up the beams, the structural integrity of the entire enterprise depends entirely on getting that basement in order. Thank you for joining us on The Debate.